Welcome to this video about the world of futures. Today, we are going to explore how the derivatives market actually works by looking at the key people involved, the ways they manage risk, and the strategies used to set fair prices for these contracts. You can think of this as a guided tour through the machinery of modern finance. To understand how the market moves, we first need to meet the three main groups of people who participate in it. These are the market participants. First, we have the hedgers, who are basically looking for insurance to protect themselves. Second, there are the speculators or traders who are looking to make a profit by taking on risks. Finally, we have the arbitrageurs, who act like investigators, hunting for tiny price mistakes between different markets to make a safe profit. Let's start with the hedgers. You can think of a hedger as someone who wants to lock in a price today to avoid a surprise tomorrow. Imagine a farmer who is growing wheat. They are worried that by the time the wheat is ready to harvest, the price might drop. To solve this, they sell a futures contract now to lock in a guaranteed delivery price. On the other side of the world, an investor might own a large collection of stocks and worry that the whole market is about to take a dip. By selling index futures, they can protect the value of their portfolio. In both cases, the goal is to reduce exposure to the unknown. Next, we have the speculators and traders. Unlike the hedgers, these people actually want to take on risk because they are looking for high returns. They use a powerful tool called leverage. Leverage is like a magnifying glass for your money. It allows you to control a very large amount of assets with only a small deposit. If a trader thinks a stock is going up, they go long. If they think it will fall, they go short. While this can lead to big profits, it is a double-edged sword because it can also lead to large losses. Their main job in the market is to provide depth and liquidity, making it easier for everyone else to trade. Now, let's look at the arbitrageurs. Their role is to keep the market honest by exploiting mispricing. Imagine finding a store that sells an item for 10 rupees and another store right next door that is buying it for 12 rupees. An arbitrager would buy from the first store and sell to the second simultaneously to pocket a risk-free profit. By doing this, they bridge the gaps between different exchanges and help the market reach a fair price more quickly. To see this in action, let's look at a simple calculation. Imagine an asset costs 100 rupees today in the cash market, but the futures contract for the month of May is trading at 110 rupees. An arbitrager sees this 10 rupee gap and locks it in by buying the asset now and selling the future. No matter if the price goes up to 108 or down to 95, by the time the contract ends, the 10 rupee profit per unit is already secured. This keeps the market efficient, though in the real world, we always have to account for costs like taxes and brokerage fees. When we move into the world of index futures, we have to talk about two different kinds of risk. Think of your total risk as a combination of two things. First, there is unsystematic risk, which is specific to just one company, like a strike at a factory or a change in management. You can get rid of this risk simply by diversifying, which means owning many different types of stocks. The second type is systematic risk. This is the general market risk that affects everyone, like a change in national interest rates or a war. You can't avoid this by diversifying. So we use index-based derivatives to help manage it. To measure how much a specific stock or portfolio moves compared to the general market, we use a number called beta. Think of beta as a sensitivity meter. If a stock has a beta of 1, it moves exactly with the market. If the beta is 2, the stock is aggressive. It might go up 20% when the market only goes up 10%. A beta of less than 1, like 0.5, is considered conservative. To find the beta for a whole portfolio, we just take a weighted average of all the individual stocks inside it. Using these tools, we can decide how to protect our investments. If you own a specific stock, you might use a 1-to-1 ratio, meaning you sell one futures contract for every block of shares you own. However, if you have a diverse portfolio, it won't move exactly like the market index. In that case, we use a special formula. You take the total value of your portfolio, multiply it by your portfolio's beta, and then divide that by the value of the index futures contract to find exactly how many contracts you need for a proper hedge. There are two main ways we use these hedges. The first is a long hedge. You use this when you expect to receive money in the future and want to buy stocks, but you are afraid the prices will go up before you get the cash. By going long on futures today, you protect your future buying power. The second is a short hedge. This is for when you already own a portfolio but are afraid the market will fall before you are ready to sell. Selling futures today helps compensate for any loss in your portfolio's value later. Sometimes the exact contract you need isn't available. In those cases, we use a cross hedge. This is like using a close substitute. For example, if there are no futures for jet fuel, an airline might use crude oil futures instead because their prices move in a very similar way. Another important rule is choosing the right month. You should always pick a contract that expires just after the date you plan to finish your trade. If you need to protect yourself until June 20th, you should pick the June contract rather than the May one. Traders also have different ways of positioning themselves in the market. A naked position is a straight bet that the price will go up or down, leaving the trader fully exposed to market movements. A more conservative approach is called a spread. This involves taking two opposite positions at the same time. You might trade two different but related products, which is an intercommodity spread. Or you might trade the same product but with two different expiration dates, which we call a calendar spread. These are generally seen as less risky than naked bets. Arbitrageurs also have specific strategies they follow. Cash and carry arbitrage is when you buy the asset in the cash market and sell the future. Reverse cash and carry is the opposite. You sell the asset and buy the future. There is also inter-exchange arbitrage, which happens when the same stock is trading at two different prices on two different exchanges at the same time. While these opportunities are usually very brief, they are vital for keeping prices aligned. To know if a price is actually wrong, we use the fair futures price formula. Essentially, the fair price of a future should be the current spot price plus the cost of holding that asset until the contract ends, such as interest or storage costs. We call this the cost of carry. If the market price of a future is much higher than this fair price, it signals a profit opportunity for a cash and carry trade. Finally, let's look at intermarket arbitrage. Imagine a stock is trading for 101 rupees on the National Stock Exchange, but only 100 rupees on the Bombay Stock Exchange. A trader would quickly buy at the lower price and sell at the higher price to gain a profit. In summary, futures are incredibly flexible tools. They allow investors to quickly and cheaply change their risk levels, whether they want to add risk to chase profits or reduce risk to protect what they already have. Just remember, in the real world, always keep a close eye on transaction costs and fees before making your move.